This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. This is another one of my subscriber request series. As for disclosure, I'm actually long what will turn out to be RTX. But I've been asked to go ahead and look at this company. You know, there's been a merger between United Technologies and Raytheon. And what I want to point out is that when something like this happens, it kind of muddies up the history a little bit, although it doesn't completely make the history irrelevant. So what I'm going to do here, I'm going to start by looking at an existing graph of Raytheon. Now, I want you to notice that this graph ended on April 2nd, okay? So this is not a current graph. There is no such thing as a graph that I can produce on Raytheon, the symbol RTN, because the company now is different. But I want you to notice some of the characteristics of this company. Has pretty good earnings growth, a little bit of moderate cyclicality. You can see the stock price has tracked that. As a result of the coronavirus, you see that the stock price has fallen precipitously on the then Raytheon company before this final merger took place. The forecast for the earnings growth, though, was still very strong on this company going forward. I do want you to notice that. Now, when you see a blank like this just means that there's no analyst giving an estimate on dividends. That doesn't mean that the company's not going to pay a dividend, or the company doesn't even exist anymore under this configuration. But then the next company I want you to look at is the other company that was merged here, which is United Technologies. And I want you to notice the similarities here. This company, again, was moderately cyclical. We had this big drop-off. We were expecting a down year in earnings this year, followed by a forecast for earnings growth. And this is the old United Technologies. Once again, I've only got April 2nd here. So this is a graph, again, that doesn't exist under the symbol UTX or United Technologies. But United Technologies also spun off Carrier and Otis Elevator, which were two additional spin-offs, which would make even analyzing this particular company even more difficult, because not only did it merge with Raytheon now as a result of this original merger, but they also spun off the other two companies that are now publicly traded companies. So that brings me to the final example here, which is the new company. But I want you to keep in mind, I want you to focus on the operating history of United Technologies here, and then remember what we saw with Raytheon. So let's go into the new under the symbol RTX, and the company is now called Raytheon Technologies, which is a blend of the two names. And I want you to see that this graphic here, it looks more like the United Technologies historical graph. It also looks like somewhat like the forecasting graph, but kind of blended in with the Raytheon, if you will. Now, when I look at stock price, we're really, I think, looking at the historical United Technologies. So this is all about the, looking at the future. Now, part of this earnings drop has to do with the fact that those two companies were spun off out of this new conglomerate, if you will. But nevertheless, when I look at forecasting, I do see good growth going forward once we get past 2021 and this actually, or 2020, and this actually includes any impact that we might have had from the coronavirus. These estimates have been updated because this is actually a new merger and a new IPO. Regardless of everything that I've said here, and although it makes analyzing of this company somewhat difficult, I think the real key is that the stock is inexpensive today. It's trading at a discount to its normal historical valuations, which you have here. It's normally been about a 16 to 17 multiple company, but it's also trading at its normal theoretically intrinsic value. So company's yielding over 4.6%. As of today, though, the company did have a pretty decent upside. It was up about 3.6% as of about 2 minutes away from 4 o'clock. So I'm going to say this is probably a pretty good quote for the company here out of the Wall Street Journal. So we had a good trading day today. The stock is up. Forecasts for earnings beyond 2020 look very strong again. If I go back here and look at what analysts expect, the long-term growth rate is expected to be over 8%. So, this is a company that is pretty strong. I really like the combination here. I would go in and look up the new company now and try to do your due diligence, because there is a lot to learn. Again, the history is relevant to United Technologies and Raytheon because they were very, very similar, but we're really taking the United Technologies history here and applying it now to the new company, RTX. Since this is a dividend-paying stock with about a 4.7% yield, I do want to take a look at operating cash flows here, because the expected operating cash flows of the combined company are where I really see the opportunity here with this particular stock. Now, operating cash flow is expected to grow dramatically, over 30% in 2020, followed by over 51% for 2021. So there's a lot of optimism on what the cash flows of this company might look like. And so from a standpoint of dividend coverage, I would say, in dividend protection, I would say we have a very secure dividend here. And, the company is still generating strong free cash flow. And the historical free cash flow, again, we're looking at, history of different companies being merged here. But I do believe you can learn a lot. Both of these companies had good numbers historically, or all three of these companies did. If I went to United Technologies and looked at them, you could see their free cash flow, and that's what we're looking at with the new company. But then if I also went to the original Raytheon and looked at the original Raytheon, you could see that they also had very good cash flows. So I believe the merger here has created a very interesting opportunity to invest in a very strong company, or companies really historically, two what I would call dividend-paying stalwarts in the aerospace and defense industry have now become one bigger, stronger company that you can buy at a very attractive valuation. I do want you to notice that this stock normally trades at a premium to cash flows as well as a premium to earnings. So being able to buy it at this discount would be attractive. Hey, this was a subscriber request series. I am long this particular stock. I would be aggressively willing to buy it at these levels here, but I'm saying that from a long-term perspective because I would plan on owning this stock and do plan on owning this stock for many years to come. And I really like the opportunity that the market has given me here. I hate the crisis, but I like the market opportunities. Anyway, this has been Chuck Harnabell saying thanks for watching. This was a subscriber request series. If you like what you saw here, please hit the subscribe button and subscribe to my YouTube channel for more videos like this coming up. Thanks, everyone. Have a great Easter holiday.